2012 ended on a positive note, with a last-minute agreement providing a partial resolution to the fiscal cliff in the US. Improving momentum in the global economy, easy monetary policies at central banks, and increasing likelihood of significant policy changes in Japan all supported markets. Global equity markets in December rose 2.2%, led by Japan, which was up 10.5%, with Asian markets up 3%. Europe rose 2%, while the US lagged up 0.9%. Eurozone bonds rose 1% as German and Spanish yields fell, while Italian yields were flat. An agreement to maintain tax reductions for approximately 99% of the population and delay automatic spending cuts for another 2 months reduced the negative impact of the fiscal cliff on GDP to around 1% instead of 4%. Discussions in coming weeks will focus on addressing reductions in spending levels, the longer-term US fiscal deficit, and raising the debt ceiling. The debt ceiling is the maximum amount the US can borrow to fund government spending, and has been raised on 79 occasions since 1960 and currently stands at $16.4 trillion US dollars. If the ceiling is not raised, the US will be unable to fund itself and implement spending programs. Similar to the fiscal cliff, we expect a last-minute deal to raise the debt ceiling, but markets will be sensitive to news flow on negotiations relating to the debt ceiling and decision on spending cuts over the next few weeks. The LDP won a landslide victory in the Japanese general election and are seeking to boost the economy through fiscal and particularly monetary stimulus. The new government is aiming to double the Bank of Japan's inflation target to 2%, which is a step change in policy and would result in further significant monetary easing. New appointments to the board of the Bank of Japan, with a disposition towards easing, facilitate this policy change. In expectation of this, the yen has already weakened to a 2.5-year low against the US dollar, which is positive for exports and the overall economy. In addition, a fiscal stimulus package is expected to be announced shortly. The easing of political tensions following a territorial dispute with China should also benefit the economy. Global economic momentum has improved, with increasing signs of a pickup in final demand and rising new order levels relative to inventories, which suggests production levels should rise. Chinese data continues to improve, while business sentiment surveys in Europe are more positive despite recent weak economic data. In the US, the partial resolution of the fiscal cliff reduces uncertainty, while the housing and labour markets continue to strengthen. In relation to monetary policy, in addition to moves in Japan, markets expect further reductions in interest rates by the ECB through 2013. Recent comments from the Bank of England Governor-designate, highlighting the merits of nominal GDP targets and numerical thresholds, suggest further easing might be evident after he takes over in mid-2013. In the US, while there is debate among Fed members over when asset purchases should end, they are likely to continue for at least most of 2013, amounting to a still significant $1 trillion over the year. Overall, monetary policy will remain supportive for markets in 2013. Markets year to date have reacted positively to the fiscal cliff outcome. The improving global economic backdrop, ongoing monetary support, reduction of risks in Europe, and attractive valuations provide support for further gains in equity markets in 2013. In Eurozone bonds, the low level of absolute yields in core markets indicate returns over the year will be slightly positive, with room for further narrowing of peripheral spreads against Germany, as yields in Italy and Spain can continue to decline.